Welcome back to smarthelping.com. I've got a doozy for you here. I finally finished the mobile home park upgrade, and it took about 4 weeks, a lot of hours. This can also be used for multifamily real estate acquisitions or build outs as well. Essentially, anything that has a weighted average lot rent and then some occupancy over time and some uh, rent growth. Those are the main limiting factors of if it can be used or not. Other than that, this model will allow for up to 40 properties to be input with um, all having their own assumptions, and it will flow for up to 16 years worth of time. So what I'm going to do is I'm going to go through every tab of the model, explain it, and then you'll understand what's going on here. Don't forget to subscribe below. Also, the template will be available in the description box link below. This is going to be a $175 one-time fee, and one of the reasons why I'm doing that is because this actually includes three other um, waterfall distribution models that are separate that I've integrated in here. I'm thinking about doing a fourth. Also, I'm open to suggestions on this. All right, so let's get started. Control tab. So it was very difficult to figure out how to scale 40 properties, all having their own assumptions. So what I've done is I made the excuse me. I've I've made it so that the loan and refi are the same for everyone. So no matter which property it is, it's going to have the terms for any debt taken out is going to be the same. The amount of months until refi is going to be the same, but it'll still be unique to when that property is planned to come online. So that part is dynamic. So anyway, to start here, edit cells in light yellow with blue text. This is the start year of the forecast. So this would be the year uh, costs start going out and potentially operations begin. Always put the first um, day in the first month of whatever year it is. Next is the exit assumption. So this is also going to apply to all the properties at the same time. You can pick an exit month, any month in the entire forecast, and it'll stop the model at that point. And upon exit, a cap rate will be applied, as well as any seller and prepayment penalties for any debt that exists. Um, the initial loan terms, you've got LTV. You can also define if the initial loan that is brought on is interest only for any amount of months. Then the interest only rate, the amortization schedule, the term, which is different than amortization, interest rate, and payments per year, which this is all hard coded to 12, so don't ever change the payments per year. It's going to be 12. You can also decide if there is debt in a given property, you can pick if it's going to have a refi or not, and this will apply to any property that is going to take on debt. So you can toggle that. You see, adjust the numbers. And then the refi, you can also define that LTV, the year that the refi happens in, the amortization and term and interest rate for that. Payments per year is hard coded to 12. The refi cap rate, which we need to know to figure out how much the loan's going to be, and any lender and pre-penalty payments for that, lender fees and prepayment penalties. Um, and these are just applied to whatever the refi incoming disbursement is. That will be reduced by both of these fees. Um, the lender fees are applied to the refi amount. The prepayment penalties applied to the initial loan, initial balance. Then you've got an assumption here that's going to flow over to the build out assumptions for loan to cost to define if there's construction, new construction or renovations, how much of that will um, the bank cover. And then these are just summaries. I normally don't put summaries on initial control and build out tabs, but I did on the control tab here just so you can kind of see high level the different IRRs of the three waterfalls that the model uses, and you could use any option. Um, Also, a little visual on that. I thought that looked kind of nice, so I put it on there. And then the split. So this will define of um, the aggregate equity requirements. This will define how much comes from the general partner versus the limited partner, and that will flow to each waterfall option as well, which I'll show you. Um, and that's just because in each of these deals, we're assuming it costs a certain amount. Then you've got operations potentially burn at the beginning, maybe not though. And then you're only going to be able to finance some of those startup costs with some debt. So the rest has to come from equity. And so this defines how much from a sponsor versus an investor. So we can do all the joint venture logic. If it's not a joint venture and just you, then you could obviously just set this to 100%, and it'll just show the results for the whole project in the equity requirement of the project for with no splits of cash flow. All right. Now this is the most important tab, probably the build out assumptions. This is where you'll spend most of your time. And it's very important you don't change the column positions. I have used index and match. There's no V lookups going on, but it's still important to just not mess around with the structure formatting of the entire model. So just enter, whatever park name or property name you've got here. The start month. The start month will define when the cash is required for the startup costs and potentially the acquisition. Then you can define the amount of months for every single one individually that it takes until operations begin. And operations beginning just means rent's going to be starting to be collected based on the unit count. And then for acquisition, so you might not be buying all these, but some of them you might be. You can define what the current annual NOI is and the entry cap rate, and that will give you some value that you're going to pay for the park. Then you potentially have construction costs. And no, I made all these the same here because it was really easy to do my sanity checks and make sure all the calculations are working right if everything was the same. So I could really tell if the numbers were pulling through correctly, which they all were. Um, but you can put in whatever amounts here for the given properties for construction or other if applicable. Then you've got your total cost of acquisition. It's those two combined. You can define on individually each park if it's going to have debt or not. If you hit no, you see for Mobile Home Park 2, if we go to the amortization schedule, see number 2 is all zeros here. If I put this back to yes, you see now we've got numbers here for 2. Um, and so if yes, it's showing the debt here and equity here of each one individually. So what I've done is I've aggregated this assumes every individual property can have its own structure for debt and equity, or as well as is different costs and different times that it takes to start and different start months. Um, but they all follow the same structure of debt if there is debt, and then they all have their own unique assumptions for revenue, occupancy, and expenses, which we'll get to in a second here. And note that this debt is all dynamic. So there's an amortization schedule for all 40, up to 40. And if you don't have 40 or you just have a couple, that's fine. You can just clear all the data out. I'm going to have a light version of this where I just remove basically all the calculations except for 5. So that'll make it the file will run a bit faster. It's not that slow right now, but if I remove everything except for 5, it'll be really fast. So when you purchase this, it will include both the light version of only 5 and the main version that has all 40. And so you can see here on this amortization schedule, I had to literally go through, and there's a lot of checks that were done to make sure this is accurate. But you can see, look, MPH number one, um, all the amortization schedule, the refi happening, all that logic, refi cash in, prepay or repayment, and then when the exit happens here, or actually there is no exit, but if I put an exit in a given month, let's say November, then you can see exit happens, and then there's exit cash. There's also repayment of debt. So that was a tall order to do. There's just look at this. There's literally this times 40 times, and this is the only way I could think to do it where it gave enough granularity per property, but also I was able to keep some high level assumptions that affect everything in the most efficient or most accurate way that you can do in order to try and plan out like the build out of multiple properties over time with all these different things going on. The debt really presented complexity in a lot of different ways, but it's all done. It all works exactly like I was hoping it would, and um, it's really cool. I'm super excited to get this out. Like this is super. I think this is like one of the most helpful models that will ever exist. Uh, so you can see all 40, up to 40 slots here. Um, and then, so let's go back to the build out assumption. So for a given property, you can define its starting unit count, the weighted average lot rent, the lot rent growth in years 2 to 4, which means so year one is going to be whatever you put in here. And then year two, it'll increase by this percent. Year three, it'll increase again by that percent. In year four, it'll increase by that percent. And then in year five of the given property, and again, the year of the property will depend on when the start month is, and that's all dynamic as well. So whenever year five hits for a property, it's then going to stabilize and go to a new rate and go to that rate. And the reason why I set this flexibility up is because oftentimes, a developer or a strategy group is going to go in, buy a park or buy some parks, put in upgrades, and then over the first few years, they're going to raise the rent at a higher rate, and then that'll likely stable off over the longer term. And because we're going out for 16 years, I thought it was definitely relevant to have two different rates. Uh, for initial, basically the first few years it increases higher, and then you can do a lower rate for stabilization. Also for occupancy, you could define the occupancy for every single one individually. It's going to give the vacancy improvement per month. So this is just saying you start at 80, in month two you're at 81, and you can put this at whatever percent. You can put it really low or whatever. And then you also have a max stabilized occupancy, meaning it'll never get above whatever you put in here. So it could be 100. It can't be over 100, um, but up to 100. And then however many months it takes, um, based on this rate to get from here to here is how long you'll see, or how that's when you'll still see improvements in occupancy. So that's happening at the same time as the rent increases are happening. You've also got expenses. So what I have here is, and you can change the names of these. So I've got up to 17 expenses, and they could be whatever you uh, plan on having. You were going to put the annual amounts in for each of these. The only thing that's unique about this is column Y is a management fee, which is doing a percentage of the gross revenue. This cannot change. I'm going to put here, um, don't change. Uh, or no, you can change the percentage. Don't change. Um, or I could actually this column percent will always apply to gross revenue. Hopefully you're watching the video so you can just hear me say it so you pick it up, but that column needs to always Man, I wish I could actually go even lower, like a 6. Okay. Yeah, so that's always gonna column Y is always gonna be looked up and applied to that. If there's no management fee, just put 0%, but don't like put a like $10,000 in here because the logic for this specific row, which you can see in all these, if I just look at that for management fee, it's always doing um it's always doing that column based on uh a percent, which this has a different formula than all the other OpEx stuff. So just be aware of that. Then you got, the rest of these you can define however. So you're essentially defining the drivers for revenues, expenses, and then net operating income will be derived. There is an expense growth for each of these, which it can be any percentage. Um, so after you've put in all that stuff for however many parks you have, you can see the monthly detail has literally a P&L for all 40 properties. And the P&L includes, it gets all the way down to value, net operating income, the initial loan, principal and interest, debt service, refi disbursement, exit disbursement, and initial cost. So this is on an individual basis. All this stuff is populating. Um, and the reason why I wanted to tag all this stuff is because number one, you want to see, like, let's say you only do a couple, you want to see individually what's going on with every property. And there wasn't really any better way I could think to do this than have it called out all 40 different times. Also, it allows us to create some summaries. Like when we get here, you'll be able to see like the net operating income per park, initial costs, loan amounts, refi disbursements, if applicable, debt service, um, exit value if there is any, net cash flow for each park. So all that was only possible if we're going to call out everything in this monthly summary detail. So this goes down. You can see all for all 40. And then at the bottom here, we've got cash flow. And this is how we figure out the exact actual equity required. And it's based on the debt and equity on the total cost for each property. Also, if there's any debt service against the net operating income, if that's a negative number, that'll be some equity required on top of the initial purchase and acquisition or construction. And then you can see the total equity requirement is going to pull down here, and then the equity distribution they're going to pull here for any positive values, which we don't get to for a bit. You see once the NOI gets positive here, less debt service, there's now distributions available. There's still, let's see, this is 30, and I think in this model I've set it up so there's just one new park a month. So in here you can see that the cost to add a new park per month is the same each month because I just set it as the same, but it'll be different whenever you put in your actual numbers. Um, so you still got that equity requirement happening, which is the cost of the park. And now that net operating income is greater than the debt service, that's actually distribution now. So now the only cost hitting this equity is just new developments. Uh, and it's really cool. Like you can see, let's see, where do we got a refi? Uh, so here some refis are hitting. So these are the initial loans have now hit their refi mark. So you've got cash coming in from that. You've got the cash going out to pay the principal. Um, you've got still initial loans being taken out because you're still adding parks at this point. You've got net operating income. You've got the total cost of the new parks. Uh, and all of this flows through, and I've done so many checks here to make sure all the numbers. So the checks are basically checking to make sure the total numbers here for debt and equity are equaling the totals when I sum up all the numbers on each of the P&Ls of all 40. So that's checking to make sure these formulas are correct and pulling the right data, which they are. It's true. And this should always equal to 0. This should always be 0. This should always say true here and here. I've split out principal and interest payments by month on an aggregate level. It's not doing it on a per park level. You can see the principal and interest, but in this level, the principal is actually going to include the um, on a refi it'll include the principal repayments, or on an exit it'll include that full principal amount being repaid. But the aggregate is called out at the bottom, so you see this is just principal repayments, and this is just amortization. So this is the regular principal and interest payments, not including like if the term's up, or if there's a refi, that's included in the separate row. And then so this is principal interest. This is this number split out. You see 789, 641, 789, 641. So this is the total amortization split between principal and interest only. Uh, so you can see that. Um, if we go to the annual detail, same exact thing, except we're looking at an annual level instead of a monthly. So you can see all 16 years here. You see the cash required, cash distributed, the net cash flow of equity. It is important to note that this equity requirement is actually pulling from the monthly, and that's because I wanted to get it so I didn't want to net together the distributions and contributions if there was a partial. So you can see in year 3 here, you've got uh, you've got some positive distributions, but you've also got some negative. So in the annual summary, this will all look like one positive number for the year. If you add up all of this, it's positive 67,000. So that's what you'll see here, positive 67,000 for year 3. But that's broken down between having some of that was distributions, and then some of it was burn. So I've called out exactly the difference, so we know what was had to be contributed versus what was given out, and then the total will always net together to be the same exact numbers that's on the monthly, but the contributions and distributions will be potentially different if you have a year where some of it was um, the net operating income less debt service was negative for some of it, and then it was positive for other months. Uh, which this completely fine. Our aggregates all match up. Um, then flow checks. Then here's some summaries I did to do cool charts showing like the total debt taken on versus the total repayments made. I thought that was interesting. So the debt is going to be the initial loan, and then plus any refinance, and then the repayments are obviously you're repaying the initial debt, and then you won't pay the final amount until if there is an exit. If there's not, then the total will not be repaid in the model because there's no exit. So you just have some debt number and some total repaid number, which is fine. So that's the guts and bones of this thing. The MHP detail, which we kind of went over, just shows you by mobile home park property what is, the operating income for each year, what's the initial cost, what's the initial loan amount, what's the refi disbursement amount, what's the total debt service. And you can see this includes the refi. So you got principal interest, principal interest, principal interest, refi. So you're paying back a bunch of principal, but you're also getting a new loan that's more. So now you got principal interest again. And depending on how the loan goes, how the growth of the property is, the principal interest might be higher or lower than it was before the refi. It just depends on how your assumptions are planned out. Exit disbursement, which we put NA. Let's just put it in there so you can see it. So you got the exit of each park, which numbers are different, even though they're all the same assumptions because they've been around for different amounts of time. So the net operating income is going to be different over time, meaning that the valuation is different over time. And then the net cash flow for each park. And then this net cash flow in aggregate will always equal, so 286 million. This will always equal what the total of this row is, 286. And then it'll also equal all the waterfall total contribution distribution summaries. So let's get to that now. So we've got waterfall option 1. So I've taken, so these are separate models. Waterfall option 1, option 2, and option 3. These are all separate $45 templates, but I've integrated them all into this included because they're all super relevant. So as a user of this, you can decide and see the differences between doing an IRR waterfall like you see here. And this is more of a soft equity where essentially until the investor gets 10% return, cash is split, distributed based on pari passu, which is whatever they put in, they get out. So you can see we started at 80-20 split. So this is saying all the contributions are split 80-20 between um, the investor and the sponsor, and then the cash flow will all go, well, essentially the cash will be split in the same way. So 80% of the available cash distribution will go to the LP, 20% will go to the GP, up to the LP getting 10%. As soon as the LP has reached that 10%, you go to the next tier. Now cash is split um, at a 75-25 rate, so different rate now for tier 2 distribution. So the LP is saying, okay, if you can get me a higher internal rate of return, I'm willing to give up some of my cash flow to the general partner, and so on. If you get over 20, or let's see, this is up to 10, then this would be up to 15. This would be up to 20 is 70-30, and then over 20 would be whatever you put in here. And you could define these however you want based on whatever deal it is. There's no right or wrong here. It's just whatever you've decided on in the contract or the deal with the LP and GP, and you put these numbers in here. Tier 3 again, so you're going 70% to the to any cash distributions to the LP that gets them between a 15 and a 20% return. You can see here's a check for 20% IRR, and then as soon as that's hit, now the cash is split 50-50 as we define here. We can put this, let's say it's split 60-40. So then these changed a little bit. So this is just a standard internal rate of return waterfall with different hurdles. You can see the final summary down here, the equity multiple for the LP, for the sponsor, and the internal rate of return for each. And then I just put a chart that shows the cash flows for each over time. So you can see the investors putting in more, they're getting back more early, and then as soon as they've gotten whatever their hurdles are, the cash starts to get more even towards the sponsor, and then um, the exit here has the final flow. So that's one option. You could also do option 2, which is a preferred equity waterfall, and this is a hard preferred equity, meaning so here the investors giving 80% of the needed cash, and then any cash distributions available, the preferred pool will get 100% of that until their full initial investment is paid back plus whatever return you put here. So this is saying they get 11% return per year, and then they got to get paid back all the equity they put in. As soon as they get that paid back, then cash can start to flow to the sponsor. And then you could define, this is essentially the kicker, or basically how much the preferred pool is going to get after they've fully been, it could be zero, which means that the preferred equity gets all their money back plus an 11% per year return. And then if this is zero, then any remaining cash goes to the sponsor. Or there could be a kicker here saying any remaining cash after the preferred equity pool has been satisfied will be split 20%, 80%. And you can see that split happening here between so this is the investor, preferred equity, this is the sponsor. Um, and you can see really not until that refi hits, that's when there's some cash available. And there's refis happening in year 4, 5, and 6 based on our assumptions. So cash starts to come available. So now we're paying some of the shortfall, paying some of the preferred return due. Um, and then finally, after year 5, they're fully satisfied. And in year 6, now some can go to the sponsor. You can see the internal rate of return for each preferred versus sponsor and multiple of each, and then the cash flow of each down here. So again, this is similar to the other one where the investors put in more, they're getting back more initially, and then once they get back their full amount of investment plus the pref, cash starts to be split between the two. Option 3 is a preferred return. So this is similar to the preferred equity, except for now the only thing that happens is so the initial cash is still split. The initial cash contributed is still split based on the defined assumption in the control tab. But now the preferred return investor is only going to have to get their pref return back. They don't need to be paid their entire principal back before the cash goes to the sponsor. So in this case, as soon as cash is available, is you can see here in year 3, cash is available, but the pref return is still higher than this. So the um, pref gets their basically all of this, and then some actually rolls over to year 4. And now in year 4, there's $16 million. There's been a refi, so there's some more cash available. Now they're getting their return, pref return that had accrued in all 3 years based on their equity contributed in this return right here. So they get all that back, plus any split available after that is returned as 50-50. And this just doesn't, it's very similar to the preferred equity, except for there's no logic that says the pref has to get their initial um, investment back. It's just they get a certain return, and that can accrue or not, depending on what you want to put here. And then after that return has been satisfied, that's why it's called preferred return waterfall and not preferred equity. The return is satisfied, now cash can be split based on whatever is input here. So uh, you see here the pref is getting some, the sponsor's getting some, the sponsors starts to get more um, as the pref is getting paid back, and then whatever this is defined as is split evenly. Here we just did a 50-50. Um, now, let's see, 2. Oh, right. So the remaining cash is split evenly, but you can see the return is never bought out, and there's no logic to buy them out. So whatever cash they put in, they're going to get that 10% return into perpetuity. And because their initial, they're not being paid back any more than what the return is, so they have, their investment is still in there collecting a preferred return. So even though you see 50-50 split here, um, the pref is getting a little bit more because they're getting a pref return, and then anything left over is split 50-50. So if there was, if you wanted to buy them out, well, I mean, you could, the sponsor would have to front all of that money up to them, and then assuming they did, they can keep the rest of the cash flows. But that would take some finesse to do here, and this is not what the model was made for. It's made to just do a pref return for the life of the investment. Um, so that is the three waterfalls. So I got some visuals here. This shows all three waterfalls summaries in one look. It also shows some uh, summaries about the mobile home park or real estate project you're doing over the whole full 17 years. So net cash flow, net operating income versus debt service. This is an important one because usually you have to make sure when you do these refis that the net operating income is high enough to fund the debt service of the new loans. So this shows some detail on that. Total mobile home park count or total property count if you're not doing a mobile home park here. Debt summary. So this is showing cash um, financed from banks. Then this lighter yellow one is showing refi cash in, and this is showing principal repayments. And then, so I thought that was kind of cool to see. Okay, here's my money coming in from the bank. Here's the refis coming in, and here's the repayment of the initial loans, and then here's the final repayment. And then the principal repayments will be slightly less um, than like let's see, I'm trying to think how to show this. Because there's lender and prepayment fees, the total debt received is going to be a little bit more than the debt repayment if there's fees here, because the refi cash distribution is going to be less based on whatever the lender fee and or prepayment penalty is. So it's hard to see on the chart because there's numbers are so big, but if you look here at the annual detail, you can see total debt funding less um, repayment fee. So this is how much you're getting, and this is how much you're paying back. So you've actually paid back more than you've received because of those fees. Now, if we put the fees to zero, we still have seller fees in there. That's not going to affect that. So if we put these to zero and go to the annual, you can see now that the total debt funding equals total debt repayment. And that assumes we've got to exit. So we're paying back all the debt we owed. Um, and and they match up, so that's good. The math is working there. And you can see on you can't really tell in the visuals, it looks nearly the same. Uh, but this is just showing you how much you've repaid, how much you've taken out based on the refis. Now, the refis don't have to happen. If you're not going to do a refi, you can always hit no here. That's fine. Um, now, essentially, the repayments are a little bit lower, but the ratio here is just different with how much you've gotten funding, and then that's just repaid at the end, as you can see here. We'll set this back to yes. Um, then you've got project costs. So this shows like what amount of the project costs were from acquisitions, which is this one, versus construction renovation. And that's just purely a function of whatever you're putting in for these numbers here, these three columns for each park. Then I just put the IRR and equity multiple summaries per sponsor investor in here, as well as the control. So you've just got a spot where all the visuals exist that are on all the entire model. Um, well, I guess that's it. I'm gonna post this up today. Like I said, it's available for $175. It'll be available on Eloquent as well as eFinancial Models. And obviously on my site, smarthelping.com. And I really, the old mobile home park model I had just was not on this level. And now it's, I'm very happy to make this upgrade. I think it's great. And this can be used not for just mobile home parks, like I said, but just general real estate um, acquisition deals and or construction of real estate where you're going to hold it for a long time. Uh, the assumptions will work for either or, because essentially you have unit count and you have weighted average lot rent, and then you have growth of those in occupancy over time, and then the expenses. So that is super flexible for any of those situations. Um, I've never done this where you've got the aggregate of all the debt. The hardest part of this was making the amortization tables for everyone and making it dynamic with the refi and all that. The debt stuff always just gets really complex. The waterfall stuff was fun and pretty easy to do because I already had all these models built. I had to just put them in here and adjust the references. But I'm really happy with how those turned out. It's all clear, makes sense, everything matches. Just make sure when you're working in this, you don't change the names of things. As far as so like total debt service MHP number 39, that needs to always say total debt service and then reference the name of the property. And you can change the name over on the build out assumptions, but don't change the wording total debt service because that's going to be referenced in all these aggregates. You can see CM reference anything that says net operating income, anything that says initial loan amount. So those namings are important, but you can change anything in blue text, which are the expense names, and obviously all these amounts here and the date and everything. The dates you always want to make sure they're doing the first day of whatever month you're doing. That's important. Uh, the index tab is going to just summarize every tab. Uh, I'll have the instruction. This video will be posted. Some abbreviations. All right. Well, that sums it up. So I look forward to hearing any feedback on this, and hopefully it helps you guys. I'll see you on the next one.